Hi, I'm James Robinson, and this is my stock pick of the week. This is part 3 on our series on Electronic Arts, symbol EA. Today we're going to talk about the company's balance sheet. The first thing we're going to look at on the balance sheet is the company's cash on marketable securities. Cash on marketable securities is money that they have on hand or could instantly convert to cash. So securities that they could sell for cash right away if they need to. Since 2013, this number has gone up from about 1.5 billion to just under $6 billion. Frankly, I think they have more money than they need, more money than they can justify in terms of cash on marketable securities. This is a good sign because it means the company is very, very strong. It means the company can make it through rough times like what we're facing with the coronavirus. It also means the company becomes more and more likely to start utilizing this cash to benefit the shareholders, something that I think the company's done a poor job with in the past. If you look at between 2018 and 2019, the cash on marketable securities stayed flat. What we'd like to see happen with that is a prolonged period of time where the company is paying back, buying back shares, paying off debt, and paying dividends. And my hope is that that will begin to happen now. At some point, if this number gets too high, then the company starts being desirable for guys that, leverage buyout artists or guys like Carl Icahn to come in and be stockholder activists and force the company to do it. So I don't mind buying the stock now thinking that those things might happen. To put things in context, here are the company's current assets and their current liabilities. Just so you understand, a current liability is an obligation to pay somebody or someone within the next 12 months. And a current asset is an asset that could be converted to cash or that you expect to have in your bank account in the next 12 months. And so you like to see those numbers closely offset, obviously with the benefit of being more assets than liabilities. In this case, the numbers are significant. The current liabilities for this company, it's important to note, have been basically flat since 2014. So even though the company's increased its revenues and increased its earnings over that period of time, or has done better, they've really done a good job of controlling costs. And yet, while they're doing this great job of controlling costs, they're pumping more and more money into their reserves. And again, that shows you that the company doesn't need all the money that they have. They've got a long-term run now of not needing extra cash to operate. And so my hope is that this will again bolster the idea the company will utilize that money to create wealth for the shareholders. So I touched on interest payments in the slides that we talked about with the business operations, because interest expense is a legitimate business operation, but it's also a balance sheet issue. And when I look at a company's debt, I like to look at it in context, and I like to know, the debt only matters to the extent that you have to pay interest on it. And so the fact is that if we have interest payments that are significant, I want to know about them. In this case, the company has two things. First of all, the interest payments are not significant. They're about 5% of the operating income, so they're not a significant cost. And in addition to that, they're more than offset by interest income. That shows you again that this company has, in my opinion, too much cash on hand. They should get rid of some of this cash on hand, give it back to us, the shareholders, instead of using the money to try and earn a return on investment, which return on investment will be paltry relative to the money that I could make if the money was returned to me as a shareholder. So interest payments are not a problem for this company. Interest payments are not growing in a way that's out of line. Interest payments actually result in a net profit to the company because of interest income. And so there's nothing really here to be concerned about relative to the company's debt level or the company's interest payment obligations. So if you look at the debt and you look at it, from whole cloth, you'll find that the company has, every company has both long-term debt and current liabilities. Long-term debt is money that they owe over the next 5 years, in a period longer than the next year. And current liabilities we've talked about is money they have to pay in the next year. You can see that the long-term debt has been flat since 2016. It's at about $900 million. I don't know why they just don't pay that off. I guess interest rates are so low they don't need to, and that's fine, but I don't know why bothering. When you have $6 billion in cash, why you'd bother having that kind of debt? Current liabilities oftentimes are derived from operations, right? So if you grow the operations, you have to increase the amount of space you have, and you got to increase your rent obligations or your equipment obligations. And so your current liabilities will tend to grow as your business grows. In this case, the long-term liability has been very, very flat again since 2014. So debt's not a problem, and the combined debt and long-term and current liabilities aren't a problem either. So I've talked about it before, but interest coverage ratio is an important concept if you're looking at companies with a lot of debt. The idea is how safely and conveniently and easily can your company manage to pay its debt and still have money left for other obligations. So interest coverage ratio is the earnings before interest and taxes divided by the interest expense. interest before earnings and taxes divided by interest expense. That gives you your interest coverage ratio. You like to have that number be as high as possible. If you look at this company though, I mean, we're fantastically way above where we need to be. We're almost, I'd probably call it 75 times where we need to be. 75 times, our interest coverage ratio is 75 times what we need. I like to have that number be 3 times. So again, we have way too much cash on hand at this company. And it's very reasonable for shareholders to expect that this company will start to do productive things with that cash. Another metric that I like to use when I'm looking at a company's debt is how big is the debt relative to the company's earnings. And so what I basically do is say, how many years income would it take to pay off the long-term debt? If that number gets to be too high, then it's really a problem. And if that number is relatively low, then the interest isn't really an issue. We are less than a year's income to pay off all of our long-term debt. So that gives you a sense that there's just nothing to be afraid of here in terms of the company's long-term debt. This company is very, very well financed. It's very, very secure financially. There's no reason to believe this company has any trouble in that aspect. And in fact, the only thing that I see, and I keep harping on it, is the fact that I'd like them to keep less cash on hand and give some more of it back to us, the shareholders. So that's going to cover it for the company's balance sheet. I appreciate your time. And if you like the video, please subscribe and like and give me a comment. Thank you very much.